Hello, I'm Yutaka Watanabe, a certified tax accountant. Welcome to the channel. Tax Accountant Nabe solves your money problems. Today, I'd like to talk about characteristics of companies that get selected for tax audits. If one day you suddenly receive a call from a tax office saying, "We would like to conduct a tax audit of your company," just imagining it can make your heart skip a beat, right? So, what kind of companies are more likely to become targets? Today, we will carefully break down the specific warning signs from the perspective of the tax authorities. First, let me say, this is not meant to scare you. On the contrary, this is knowledge to help you prepare in advance. Some of you might think, wait, my company? But please stay calm. By understanding these patterns beforehand, you can take proper precautions. Now, there is the key premise. Tax audits are not randomly selected like a lottery. Tax authorities have limited resources, so they essentially identify companies that show statistical signs of potential underreporting. These are what we call red flags. In other words, audits are selected based on data and analysis, not guesswork. Please keep this in mind as we move forward. So, what exactly are these red flags? Let's start with warning signs hidden in physical statements. Sign 1. Sudden increase in sales. Business growth is great. However, tax authorities look at it differently. They ask, is this increase truly from this period? Or were sales from a previous period intentionally recorded in the current one? This suspicion becomes stronger when sales increase significantly but profits do not. An imbalance between sales and profits can trigger immediate attention. Growing companies must be especially prepared to explain their numbers clearly. Sign 2. Frequent errors in tax returns or accounting records. Everyone makes mistakes. However, tax auditors ask, is this really just a mistake? Or is it intentional? Is there a problem with internal controls? When errors occur repeatedly, they are seen as a serious warning sign about the company's liability. Remember, the accuracy of your accounting directly reflects the credibility of your business. Sign 3. Continuous losses year after year. This is a very noticeable pattern. The question becomes, how can this company service despite continuous losses? Normally, a business with ongoing losses cannot sustain itself. So, tax authorities may suspect there could be unreported income not reflected in the books. Even if the business is supported by loans or external funding, you must be able to clearly explain the source of those funds. Sign 4. Profit margin significantly lower than industry average. This is one of the most overlooked yet critical points. Tax authorities do not evaluate your company in isolation. They compare it with industry average. If your profit margin is significantly lower, they will ask why. Possible suspicions include underreported sales, inflated or fictitious expenses. The larger the gap, the higher your audit risk. As a business owner, you must always understand where your company stands within your industry. So far, we've discussed financial data, but audits are not triggered by numbers alone. Let's look at operational patterns as well. Sign 5. No tax audits for a long time. This may sound surprising, but not being audited for a long time can itself be a reason for an audit. Think of it like a medical checkup. The tax office may think, it's been a while. We should check this company. This is also part of maintaining fairness among taxpayers. So, we've never been audited, so we're safe, is actually a dangerous mindset. The real goal is to always be audit ready. Sign 6. High volume of cash transactions. Industries like restaurants and retail require special attention. Cash transactions are harder to trace, which makes underreporting easier. If there is a large volume of cash movement inconsistent with company size, it raises serious concerns. To mitigate this, maintain clear post records, keep proper receipts, improve transparency. Introducing cashless payments can also be an effective strategy. In reality, there are about 10 major audits risk factors. Other examples include large loans from the company to the owner, sudden real estate purchases, complex international transactions with overly simple reporting. If any of these apply to you, do not ignore them. Consult a tax professional as early as possible. Preparation makes all the difference. Responding after an audit notice arrives versus preparing in advance lead to completely different outcomes. Now, you may feel a bit uneasy after hearing all this, but here is the most important point. This knowledge is not meant to scare you. It is meant to protect your business. So, what is the ultimate solution? it comes down to one simple principle. Always understand your company objectively. A tax audit is, in a way, a mirror of your business. Maintain proper records. Compare your numbers with industry benchmarks. Be ready to explain any unusual difference. If you do this, you can handle any audits with confidence. Ultimately, building a company that makes the tax authorities think this company is well managed. That is the strongest tax strategy. So, starting today, take a closer look at your numbers. That will be a major step toward protecting your business. Today's topics was characteristics of companies that get selected for tax audits. For more information, please visit http://watanabeyutaka.com investigation. I will continue sharing content about money, so please subscribe to the channel. Tax Accountant Nabe solves your money problems. Thank you very much.